Hello everybody, my name is CastAwayTrader, and today we have an interesting discussion. We are going to cover many points. First of all, I'll explain you main ideas behind the classic Elliott Wave theory. Then I'll introduce you the modified and, in my opinion, better version of the Harmonic Elliott Wave theory. Then we will discuss why I think a market made a major top in January 2022, and this is why I do not think we will see higher highs anytime soon. Then we will discuss what specific patterns have been in play since January 2022, and I will explain why I think that we are watching a bear market rally, just a pullback that will soon top, turn down, and we will most likely see lower lows in 2023. If we have time, I'll show you my trading chat room. We can briefly discuss GDX, we can briefly discuss Bitcoin, and we will definitely look at ES-mini and NQ-mini and DOW-mini. So let's begin. We have a lot of things to cover. First of all, I would like you to read that important disclaimer. Past results are not indicative of future profits. And this is how my website looks like, www.CastAwayTrader.com. And on that chart, you can click pricing, you can click chat room, you can read about the chat room, and you can start your trial for as low as $9.99. So basically, you will pay for 2 weeks coverage as much as you normally pay for a cup of coffee. And you can follow me on Twitter, CastAwayTrader, and let's begin. So this is the main repeating fractal, a backbone behind the Elliott Wave theory. So in my opinion, Elliott Wave theory is not about counting waves. It's about recognizing a repeating pattern. So Elliott in 1930s, almost 100 years ago, discovered that every time we have a trending move up or down, that move would be following a repeating pattern, which would be composed of 5 segments, and he called them waves. And we just labeled them 1, 2, 3, 4, and 5. And he also assumed that it would be so perfect that we would be able to count another 5 microwaves in waves 1, 3, and 5. So every time we have a push to a new higher high, he believed that that small move would be composed as another 5 wave. And because every move up makes a higher high, and every move down, those pullbacks made in red, make higher lows, together they comprise a trending move up. And we can see that the whole pattern is comprised of higher highs and higher lows. So big idea behind the Elliott Wave theory is that it's a collection of repeating patterns or fractals. And I want you to think, don't think that it's complicated. There are not so many patterns to remember, and you can easily recognize them. So once you recognize them, you will be able to recognize them in real life, and you will be able to come up with a focus, what's going on. So if you think that we just completed 1, 2, 3, and 4, so you would expect another move up in wave 5. The problem with that beautiful theory was that it was theory. And in theoretical ideal world, it would be so cool if we really had micro 5 waves in each of those waves 1, 3, and 5. But in fact, it does not happen that pretty in the real life. So Elliott actually recognized that problem. And instead of trying to find a better theory, he came up with several exclusions and like special cases. So he said, yes, ideally wave 1 should be composed of 5 waves, wave 3 should be composed of 5 microwaves, and wave 5 should be composed of 5 waves, but sometimes, he concluded, wave 5 would truncate. Instead of 5 waves up, we would get only 3 waves up. Not only that, he also noticed that sometimes the very first move up of a major low would be composed of 5 waves, but inside of those 5 waves, small waves 1, 3, and 5 would not be composed of 5 microwaves. They would be composed of 3 waves, A, B, C. And finally, he also noted that in the final thrust up, in the final wave up, we could see the same phenomenon, the same exclusion, that instead of micro 5 waves structure in wave 1, 3, and 5, we would see only ABCs, and he called that phenomenon ending diagonal. So we can clearly see that Elliott, the founder of that theory, recognized that there will be 5 wave moves where each wave would be composed of 3 waves, not 5 waves. It's very important because this is where we can switch to that modified better version of the Elliott wave theory, which is called the Harmonic Elliott Wave theory. Because this is how the 5 wave up fractal looks like under the modified better version of the Harmonic Elliott Wave theory. So you will see the same principle. Every trending move up should be composed of 5 waves. Wave 1 up, 2 down, wave 3 up, wave 4 down, wave 5 up. But we can see that every single wave here, not only corrective waves, but even impulsive waves, which push price to higher highs, they are composed of ABCs. And as I've shown to you recently, even Elliott recognized that there are cases when we can actually count waves in that wave. The Harmonic Elliott Wave theory just made the next step. It said actually in every impulsive move, in every rally, every wave would be composed of ABC. So you could say, what's the difference? And it's a huge difference. So first of all, I showed you truncation. It's very devastating phenomenon when you are in the wave 5 and you start counting 1, 2, 3, and then you expect wave 4 down, wave 5, but they never come. In many cases, they never come, and you could be following that move up for weeks only to see that price breaks down and it just starts going down without you short because you expected a perfect completion of the wave 5. But when you start applying the Harmonic Elliott Wave theory, you do not longer have that problem. You count subwave A up, subwave B down, and subwave C down. And I will show you a great example today when that specific fractal helped us to pinpoint the exact top of ES-mini today on Monday. So the same principle applies that a 5 wave up fractal is about a trending move up. We can see that every wave makes a new higher high. Wave 1 makes a higher high, wave 3 makes a higher high, wave 5 makes a higher high, and every corrective wave makes a higher low. But look, because we under that specific version of the Elliott wave theory, we have subdivision of wave 3 into ABC. Now the law made by subwave B of wave 3 becomes our additional important law, and every important law made by pullback becomes our protective stop. So that specific fractal provides us with additional tools when we track a trending move up. The same applies to wave 5. Because we expect from the beginning that would be first move up in subwave A of 5 that normally hits the top made by wave 3, then we get a bear trap ABC pullback that makes another higher low in comparison to the low made by wave 4. That's another potential entry, and it's one of my favorite trading setups. And at the same time, if you enter here, and again, that was the case on Sunday evening, I'll show you that example, that setup I posted in real life in my trading chat room. That was a great setup because we could enter the price around 39.60 with a tight stop at 39.50. So basically we risked 10 points and we expected a rally to 4,020. And that rally came up today, as we know. So it's basically that fractal. It's not about theory. It's about practice. It's about everyday trading, and you can apply that particular fractal not only on daily chart, hourly chart, but for example, in my trading chart room, I post tons of charts on tick bar charts that are micro charts that are perfectly suited for trading futures, like very heavily traded futures like ES-mini. So that's how it looks like. I suggest moving forward. So the classic version of the Elliott wave theory considers 5-wave pattern where each wave is composed of 3 waves as an exception. We call it by fancy names like leading diagonal or ending diagonal. The modified version of the Elliott wave theory is called the Harmonic Elliott Wave theory. The main modification is that it assumes that each wave in an impulsive or a corrective pattern composed of 3 waves, as I've shown you. If you want to read more about that modified, better version of the Elliott wave theory, you can find my blog on medium.com CastAway, and I will post the recording of that video with all the links I show in that video later. You can go to YouTube and search for CastAwayTrader, one word, and you will find my YouTube channel. So I will post the recording of that webinar with all the links in description of the video. So I posted a long read about the main difference between the classic Elliott wave theory and the harmonic Elliott wave theory in that blog post. It's a free one, so you don't need to pay for that just to read it. So that is the part 2, what is the harmonic Elliott wave and how it's different from the classic version of the wave principle. And part 3, which I called nitty-gritties of the harmonic Elliott wave theory that make it a superior trading tool. Basically, in that part 3, I will explain how it's beneficial for a day-to-day trading. If you want to go even deeper and start learning that method of analysis, focusing and trading, I have 2 best-selling video courses. They are published on the largest educational platform called Udemy, and you can use coupon Friendsgiving. Again, in recording of that video, I will post in details of the video direct links to those discounted offers. So you pay only $69.99 for a lifetime access for more than 10 hours of lessons, where I will explain not only the theory but numerous practical cases. And this is my second course. I would normally recommend you to start from the first course, where you will build a foundation, where I will explain basic fractals and how they relate to each other. And in the second course, we will get more practical. We will start talking about how to translate a wave count into a trading setup, which is not what normally Elliott wave analysts do. They would dump on you numerous wave counts, but we would never tell you what's the right time to go short or long. I try to do it like vice versa. The wave count for me doesn't matter because I am a trader. If I post a wave count, I really want to make money on that count. I want to, so when I look at the count, I immediately ask a question. So what would be an attractive short or long entry for me based on that wave count? And I'll show you a couple of examples later in that video. So first part of that video, let's get more practical now. I will briefly explain why I think the market made a major top in January 2022 and why we should not expect a higher high anytime soon. So I think that the market topped in January 2022 in a 5-wave up fractal that started in March 2009. So to be able to call a rally completed, we need to be able to count 5 waves up. First, we always start from looking for a starting setup we call it 1 up, 2 down. ABC up is followed by ABC down, making a higher low, and this is our starting point. This is when we start applying Fibonacci tools. It's very important to note that the Harmonic Elliott Wave theory and Fibonacci extensions and retracement tools are integrated into each other. They are integral part of one technique. Learning the Harmonic Elliott Wave theory, you will learn how to use extensions and retracements in the right way. Not only that, you will learn many new ratios nobody uses, because we deal with slightly different fractals, with slightly different structures, and this is why different ratios would apply. So we can see we got 1 up, 2 down. Note every wave is subdivided into 3 microwaves, ABC up, ABC down. This is the main distinction from the classic Elliott wave theory. Then we normally expect the first leg of a rally. This is the first part of a large and strong wave 3, subwave A of 3. This is how strong is that. Look, we apply extension to wave 1, projected from the bottom of wave 2, and we can see that it almost tagged 176.4 extension of wave 1. So you can see that subwave A of wave 3 was 1.7 times bigger than wave 1, and this is what normally happens in any wave 3. So any trader who practices Elliott wave theory dreams about catching wave 3. Then we can see a shallow ABC down. This is a classic pattern, long pattern, continuation pattern, when we get a strong move up and then we get a flat ABC structure, which is a corrective subwave B of wave 3. At that point, that becomes our critical stop if you take a long position or if you hold a long position here. Let's move on. Once we complete A of 3, B of 3, then we should expect C of 3, the second part of a strong move up. C of 3 stopped around the end of 2017, and then we got a super tricky corrective pattern, which is called expanding triangle structure. You see, it is composed of 5 waves, A, B, C, D, E, and what makes it tricky is that every successive wave is bigger than the preceding wave, and normally you would expect you get ABC down, you think this is all of wave 4, and then it starts trending up, you think okay, this is start of wave 5, and then it just drops hard. This is the drop we got on that pandemic crash, and that bottomed in March 2020, right, 2020. Once we get 3 up, 4 down, we expect the final wave 5 up. What's interesting here, we got 138.2 extension that nailed that top, and 138.2% extension was applied to that subwave A of wave 3 and projected from the bottom of wave B. We simply do not have a tool like that in the classic version of the Elliott wave theory. Then we apply retracement ratios in the same way we normally apply it in the classic Elliott wave theory. We measure the distance from the bottom of wave 2, that is the starting point of wave 3, and we go all the way up to the top made here. And this is 50% retracement. This is exactly where that huge drop stopped in March 2020. So a simple 50% retracement could help you to locate a great entry in March 2020. Big idea. A huge advantage of application of the Harmonic Elliott wave theory is that it's tightly integrated with Fibonacci ratios, and all waves relate to each other by specific repeating ratios. And as I mentioned, under the Harmonic Elliott wave theory, you will discover a lot of new extension ratios and retracement ratios that actually work on a daily basis. I never use 61.8 retracement. I never use 161.8 extensions because they do not work. Okay, let's come back to that repeating fractal, and this is your roadmap. This is your main fractal, repeating pattern that helps you to navigate through the markets from 1 minute chart to weekly chart and monthly chart. So let's look what happens when wave 3 is followed by corrective wave 4. We get wave 5, but as I mentioned at the beginning of this video, we do not expect 5 waves from the bottom of wave 4. We expect ABC up. And now I'm going to show you what kind of ABC up we got of the low made in March 2020 by wave 4. First of all, the first leg up in subwave A normally finds resistance near the top made by the previous rally in wave 3. And this is how it looked like. So that is the low, pandemic low made in March 2020. And we can get A up, B down, and C up. That B down was super small and shallow, sometimes it happens, but look, we could count 5 waves inside subwave A, 1, 2, 3, 4, and 5, and 5 waves inside subwave C of wave 5, 1, 2, 3, 4, and 5. And this is why I believe that S-mini, S&P, SPY, we all tapped in January 2022. Now, you could say, okay, we just completed a huge 5-wave up fractal that started in March 2009. So what happened then? Then we can look at that fractal. We can see that once we complete 5 waves up rally, we should normally expect a large ABC down corrective structure that normally retraces substantial part of the preceding 5-wave up rally. What's important here is that first leg down in parenthesis A is itself composed of ABC. Second leg, which is a pullback in wave B parenthesis B, is itself composed of 3 waves up. And the second leg down is a wild card. Sometimes it is composed of 5 waves down, sometimes it is composed of 3 waves down, and we will discuss both options in that video. But now let's come back down and I'll show you a couple of examples how the Harmonic Elliott Wave theory is tightly integrated with Fibonacci extension ratios. Look, when we get 1 up, 2 down, and remember, that is the starting point of any 5-wave up rally, we immediately apply extensions tools. And look, subwave A of wave 3 normally finds resistance at 100% extension of wave 1. Sometimes it's 123.6. If it tops at 100% extension, then at that point you can expect that the second leg up would top at 176.4% extension of that same 1 up, 2 down. This is why it's important for you to understand how to correctly label waves, because if you correctly label waves, you would be able at that point to build a very clean path to the top that is supposed to be made by wave 5. If wave 3 tops at 176.4% extension, then you expect wave 5 to top either at 223.6% or 250% extension. And look how it topped. It topped clearly, a little bit overshot, 3,497, but then immediately dropped down. Another example. Now we are looking at the second leg up, subwave C of wave 5 that started in September 2020 and topped in January 2022. Again, we can use a unique tool, an extension of subwave A of wave 3. Nobody uses that tool. I personally discovered that when I was trading, when I was analyzing charts, and I discovered a repeating very reliable pattern, because if wave 3 tops at 138.2% extension of subwave A of wave 3, then you can reliably expect wave 5 to top at 176.4% extension of subwave A of wave 3. Again, nobody uses that extension. Everybody knows extensions from wave 1 projected from the bottom of wave 2. And this is the beauty, because when everybody knows some tool and everybody uses one tool, it stops working efficiently. Because not many people know, only my followers and subscribers of my trading chat knows that tool, and students of my video courses. You may have hundreds of people, only hundreds of people in the whole market who knows that efficient tool. Okay, let's come back to where we are now. So in my opinion, we got the first ABC move down and it bottomed either in May or June 2022. And of that low, we got a corrective pullback, and that topped in mid-August 2022. And now the question is, so what we should expect now and where we are now on that fractal? Again, the whole idea behind the harmonic Elliott wave analysis and the classic Elliott wave analysis is to keep tracking a number of repeating patterns and trying to align those patterns with your actual chart, trying to find where we are on that fractal, because this is in essence what Elliott wave analysts do. We do not count waves per se. We only count and label waves to be able to align the actual chart with those repeating patterns we keep in mind. So every time we deal with a corrective pattern, we normally expect it to follow one of two paths. This is the simplest path. We got ABC down, and people call the structure 3-3-5. Why? Because wave A is composed of 3 waves, ABC. Wave B is composed of 3 waves, A up, B down, C up, and finally, the final strong decline in wave C, that is like flushes away every bull, makes everybody drop their longs and break under all stop levels. That is composed of 5 waves, and this is why we call it 3, 3, and 5. But in many cases, the market would not be that nice to us, and it would be playing much more complex corrective structure. But let's first stick to that simple structure. This is exactly how a pullback in 2008 and 2009 played out. Let's look at that fractal. We could see ABC down, remember this is 3 up, ABC up, 3 down, 3 up, and what we should expect, 5 down. Look at that huge decline, 1, 2, 3, 4, and 5. And together it got A up, A down, B up, C down, 3, 3, and 5. And in that particular case, we can see that wave C stopped at 223.6% extension of the first leg down. So the second leg down actually came up as a devastating decline. And that's kind of a simple scenario, because everybody is trained to be able to find that 5 wave down, that second leg down, which is composed of 5 waves. The problem is that in many cases it would not be that simple, and we would cover that topic a little bit later. But now let's start looking at the microstructure of the decline we got of the top made in January 2022. The same story, look, we got 3, 3, 3, that is subwave A, 3 up, 3 down, 3 up, subwave B, and 5 wave down, which is subwave C, and together they comprised wave A. So those 3 waves could be all of the pullback, but because we made a major top, many people by mistake thought that after that ABC down we could get another strong move up, and we made huge mistake. I never expected that. I knew we are only going to get a corrective pullback, because that 3 wave down would together comprise the first leg down in subwave A. So you see that one fractal again, ABC, this is our wave A in parentheses. So from here we should expect ABC up, making a lower high in comparison to the major top made by wave 5 of the preceding rally. Let's come back and see what we got. This is what we got. We got A up, B down, C up. And note, this is a classic, the textbook 3-3-5 structure. Look, it's ABC up, ABC down, and 5 wave up rally. Note that it's a dirty game played by the market all the time, because when we deal with the second leg up of a corrective move, apparently that means it's going to make a lower low, a lower high, and then it would start a new decline. You get a very strong move up that is supposed to convince all traders that a new rally has just started. So all bears, start panicking here after that shallow pullback, because by that point we believe we got ABC, then we get a very shallow pullback and it starts pushing high again. So this is where bears throw in the towel and they turn into bulls. They push a little bit higher, and that's the top of the whole corrective structure in subwave C or wave B. If you want to study that specific fractal, it's a bread and butter in trading. If you study it well enough, how to count 3 waves up, 3 waves down, 5 wave up, this is the only tool you only need to use in your trading. And I have a gift for you. You go to medium.com, you find CastAwayTrader. Again, I will post a link to that article, and you will find detailed explanation how that fractal is structured, how you can predict the specific point of its termination. And there is another blog post which is called How to Turn a Theoretical Elliott Wave Count into an Actionable Trading Plan. Again, the majority of Elliott Wave analysts would not tell you that, because this is what they keep for themselves. They only feed you those wave counts without explaining how you're supposed to trade them. And they say, okay, we expected wave 5, we got wave 5, but okay, wait a minute, when we were supposed to go long? This is where I'm trying to fit in, and this is where I'm trying to explain you how you can convert a wave count into an actionable trading plan. So that was a simple way of a pullback, a simple pattern. And in 50% of cases, you will see that price actually follows that pattern. If we talk about wave B, I would say in 80% of cases, you will see wave B up or wave B down following that specific pattern. This is why that black part of that fractal, it's golden. It keeps printing money for me. And this is why I strongly recommend you to learn that specific pattern. But the market doesn't like to play simple. It likes to play dirty. And this is why in majority of cases, the market plays a complex corrective structure, WXY. And it may look messy, but it's not that messy. Look, it's just 3-3-3 structure. It starts in the same way as the previous structure we just looked at and we discussed. Look, ABC down, we get 3 down. ABC up, we get 3 up. And then, instead of 5 down, we get like a real mess. But we could distinguish 3 wave down, WXY, this is 3 wave down, then 3 wave up, which is wave B or wave X, and 3 wave down, WXY. The tricky part of that is that every single wave here in that second leg down is composed of 3 microwaves. So here in that ABC down, we get that neat and clean 5 wave down. Here we don't get it. And the dirtiest trick the market loves to play by following that fractal is that that very final subwave C of wave Y of Y of Y would be the strongest drop. That is the capitulation. So where we are now, in my opinion, we are somewhere here. And we are getting a pullback in that wave B or X. B or X because we still can expect 5 wave down. So if we get 5 wave down, that would be subwave B and that would be subwave C. But if we start getting that messy path, ABC down in W, ABC up in X, and ABC down with elongated C, this is where we would need to count it as W, X, Y, that together would comprise as a final wave Y in parentheses. So let's see how it translates to the actual wave counts of AS-mini and Q-mini and DOW-mini, right? So you've been waiting for that for a long time. Okay, let's rock and roll. This is our complex 3-3-3 correction structure. Okay, this is ABC down, 3 down, right? ABC up. And that could be A down, that could be B up, and from that point, many analysts expected a clean 5 wave down. And I posted many times to my members that I had doubts. And the main reason for the doubts I had was that too many people expected that simple ABC corrective structure. And this is probably why we did not get it. This is why the market started to play a dirty game. It started to play that crazy rally that came out of nowhere. And at that point, many people start thinking that, okay, probably the market made a major bottom here in October, and we are going to start a new rally that would let us go beyond the top made in January 2022. I don't think so. And the main problem why I don't think so is that normally when we deal with a corrective structure, the second leg down, this is the first leg down, look how big is that, and look at the second leg down, it's small. If you measure that distance and you apply extension of that wave down from the top made by the corrective pullback in mid-August 2022, you will see that that move down did not tag the very minimum 76.4% extension of the first leg down. That means that it could not be considered a major top. What it could be just the first leg down in another 3-3-3 structure. So we got 3-3-5, this is wave A, 3 up, and now we should get 3, 3, and 3. And for that specific pattern, we could come up with two potential paths. So that is path 1. And the path 1 here, we are getting wave B, which is shaped as a so-called expanding flat structure. So that is our October low. From that low, we should get 3 wave up, A, B, and C. And we got A up, which is itself is composed of ABC. Now we get A down. In my opinion, we are getting B up, strong B up, and then it would need to get back down to at least 3800 in subwave C of wave B. And tomorrow, remember on Tuesday, we get PPI release, and if it goes much worse than market expects, we could get the sharp drop down. So if we get a sharp drop down to 3800, that would be an attractive long setup, because after subwave C of wave B, note, I would expect it to make a higher low in comparison to that low, I would expect another push high, and that push high could go as high as 4060 or even 4144. That's one path. Now, there is another path. Another path considers the same fractal. It says 3 down, 3 up, 3 down, and we should get 3 up. And under that path, we got A up, B down, C up. Under that fractal, we still need one more push higher to 4060, 4140. And then I would expect another strong drop, probably to 3,300 or 3,200, maybe 3,000, somewhere here, and it will definitely happen only in 2023. By the way, pay attention to the intersection of those two trend lines, and it's very important. So I love when wave analysis shows the same story as tools of technical analysis like moving averages or trend lines. Why? Because not many people practice Elliott wave analysis. So Elliott wave analysis gives you the same conclusion that could be found by applying means of classic technical analysis. So that's additional argument in favor of your scenario, which at that point could be transformed into a trading setup. This is DOW-mini chart, and DOW-mini chart has a very similar story. Look, we got ABC down, this is 3 down, then we got a tricky ABC up. It's a tricky because wave B made a lower low and wave C made a higher high, so it tricked traders 2 times. First, when it dropped down here, everybody decided that a new leg down started, and they closed down all longs and started to open new shorts, only to get another rally, very strong rally, that managed to broke over the previous high. But this is exactly how the expanding flat corrective structure looks like and works like. It's one of those repeating patterns. Again, we do not have too many patterns. I think that we have less than 10 patterns at all, and you will be amazed to see how often we see the same story. Look, the same pattern here. First move up, it was followed by a drop that made a slightly lower low just to run all protective stops, only to see another move up that took over the previous high, kept going. Everybody thought a new rally started. Oops, it stopped at 200-day moving average, the pinky line, and dropped hard. So the same story here, very similar story. It did not make a lower low here, but still looks like a textbook A up, B down, and C up. And here you can see that my red target box and how you put those red target boxes or green target boxes. You find so-called confluence of fips, meaning that when you expect a corrective pullback, what you do, you apply retracement fips to the preceding decline, and you can see 41.4%, 50%, 61.8, 66.7, and at the same time you apply extension tools to the first leg up. So you measure first leg up, you project it from the low made by a corrective pullback B, and then you see 100% extension, 123.6% extension, 138.2% extension, and when you see that they coincide with each other, you see like that retracement and that extension, they created a confluence. The second one created another confluence, and you pick a couple of levels where you got those confluence of levels, and that is your target. So all that takes just 3 minutes if you know what to do. The same story is about green boxes. You just play with extensions. First you apply extensions to that large W down, X up, and then you apply extensions to that wave A projected from the proposed top of wave B, and look how neatly they are aligned. 100% of that one and 100% of that one point to 8,550. That is actually a very feasible scenario for decline in DOW-mini to 8,500 in 2023. And this is DOW-mini, very similar structure. We got ABC down, this is wave A, ABC up. Look, we got a very tricky story here as well. We got A up, strong rally, and then it was followed by ABC down that dropped under the previous low. Again, at that point, all bulls capitulated. They closed out longs, they loaded on shorts, only to see what? We got that crazy spiky move up, return down with a very deep decline. So that is starting 1 up, 2 down. Every 5-wave move up starts from 1 up, 2 down setup, and then it took off in wave 3. Look, it stopped at 223.6% extension of wave 1. That is my favorite extension ratio. This is where the majority of wave 3 normally finds its top, and now it tagged 276.4% extension. It is possible it will stretch a bit higher. It can even convert that fractal into an expanding flat structure. This is where wave B makes a lower low under wave A, and wave C makes a higher high over the wave A. To convert that structure into an expanding flat structure, they would need to go over the top made in August. But frankly speaking, I doubt that scenario. I think we could stop right here. Okay, so we just discussed two main fractals and how we can apply them to the actual charts of AS-mini, NQ-mini, and RTI-mini. Now let me show you how my website looks like. If you want to give it a try to my service, to my trading chat room, you can go to CastAwayTrader.com pricing. So you just click pricing, and you can see several plans to choose from. The cheapest one is $149.99 for 3 months, and basically you will get an extensive coverage of AS-mini futures, and I'll show you what you are going to get for that amount of money. So basically you are going to pay me $2 of a trading day. It's nothing. It's less than a commission fee for one trade with one contract. But you only get coverage for AS-mini. If you pay $249.99 for 3 months, so essentially you would be paying like $3 or $4 per trading day to me. You will get coverage of AS-mini, NQ-mini, RTI-mini. In addition to that, you will get access to general room where I post numerous intraday updates of market breadth indicators, of volume indicators, of VIX indicators. Not only that, you will get a complimentary access to powerful suite of TradingView proprietary indicators. Not only that, you will get access to instant live alerts that produced by those indicators. And today, for example, we got nice long alerts in the morning, and then the same indicators flagged potential reversal later in the day. And if you want to get a full access, if you want to see coverage of crude oil, natural gas, gold, silver, and gold miners, and momentum stocks, you can pick either monthly plan or quarterly all-inclusive plans. And again, if you want to learn that methodology, the better and modified version of the Elliott Wave theory, you should go to my website, CastAwayTrader.com/education, and here you will see description of my 3 video courses, intermediate, advanced. You will see links to discounted offers. Now, we still have 10 minutes. I want to show you how my trading chat room looks like, and basically what kind of coverage you are going to get for $2 a day. So this is Sunday. So let's even start from Thursday. So when we expected CPI release, I warned my subscribers that we are going to get a wild reaction, and I shared 3 scenarios with them. So 2 scenarios expected move down, and then spike up like here, and that was the third scenario. I call it zombie rally, and unfortunately that was the scenario that actually played out. And you can see I expected push up, pullback, and a very strong move up over 39.28, and this is exactly what we got. Then you can apply, so here you can see microcharts. Not many Elliott Wave analysts would be posting for you numerous intraday updates based on tick bar charts. You can see so many details on the tick bar chart, so it's much lower time frame than 5-minute or even 2-minute chart. And on Sunday night, on November 11 actually, we saw a potential long scenario. And you may remember we discussed the fractal, repeating fractal, where wave 5 would be composed of ABC. A up, that would normally find resistance at the previous top made by wave 3. Then we would get ABC down, making a higher low in comparison to the preceding low made by wave 4. And then we would expect wave 5. And so basically, I said we can risk 9-point stop under 39.60 and for 50-point rally to 40.20. And look how many updates I posted. So we started to get that rally exactly how we expected. You see that move down, stopped over our support, our stop, and it kept stretching higher and was approaching the target. And then we can see that it dropped under the trend line, and that was a sign where the market is turning down. But we did not get a strong move down, and then I said that probably we are going to get another rally. Look, we dropped to the green target box overnight, and I noticed to my subscribers that if it drops to 39.70, that would be a very great long opportunity. So this is what I wrote yesterday at 8 p.m. So you got that map, trading map, basically more than 12 hours before all that stuff happened. So I offered two scenarios. Long setup. If X leaks down deeper into the green box overnight, you can consider it a great long opportunity. Entry 39.70, stop 39.50, you risk 20 points, your target is 4,020, reward 50 points. And that was the idea of that setup. So price drops here, finds support in the green box, goes up, hits that blue trend line and around 4,020, then turns down and drops to 39.50. And by the way, this is exactly what happened. Let's move forward, and this is what we got. Look, price dropped into the green target box. It gave us 3 opportunities to go long, like 1, 2, 3, and then it went up, it hit almost hit 420. It hit my red target box, and then it turned down and it dropped, I guess it dropped to that 39.86. So that's a great example for you that you can use that methodology, the Harmonic Elliott Wave theory, not only when you deal with daily charts, weekly charts, or hourly charts. You can efficiently use it for day trading, and that's a great example of that. I also was going to show you, for example, let's look at Bitcoin, right? So Bitcoin, interesting because here I posted numerous times in my Twitter, not only for my paying subscribers, but also for free followers on Twitter, that here we had a beautiful textbook short setup. Remember I told you that wave 5 should be composed of ABC. Look, the same fractal, but now it's pointing down. A down, I told you that subwave A of wave 5 normally finds support resistance at the top made by wave 3. and this is exactly where it bottomed. Sorry, it's our time is running out. Then we expect a corrective pullback B up, and then the final move down in subwave C of wave 5. And again, I told you it's a rule that subwave C in ABC should have a clean 5-wave structure. Look, we got one down, WXY, this is our wave 2, making a lower high. So this is a textbook structure. We got a deceptive quadruple bottom. This is how I call it. It dropped once, 2 times, 3 times, 4 times, 5 times. At that point, bulls start to believe we made a bottom, and that's a repeating pattern. A repeating pattern that from that point we get a corrective pullback, a bull trap. We got it. It made a lower high, and look at that drop. Exactly what we expected. And I do not think that Bitcoin bottomed. I think we made a pullback in wave 4, and we could drive it lower, probably to 13,000 or maybe 12,000, but we may not see Bitcoin under 10,000. So when you start hearing calls for Bitcoin to go under 10,000, I think it would be great time to go long. Another quick example how you use that methodology in trading would be GDX, gold miners. Look, let's open live chart, gold miners, GDX. So this is a great example. Remember I told you the best option when we get some very known pattern like invert head and shoulders. Left shoulders, head, right shoulders. At the same time it was subwave A, B, and it was a setup for subwave C of wave 1, and we got that huge rally. And one of the reasons why we got that huge rally, not because we had a clean wave count, but because at the same time we had a very clean technical pattern, very well known pattern, inverse head and shoulders, a bullish reversal pattern. And in my opinion, GDX has a clean long-term bullish setup. Look, it topped in wave 1, a huge wave 1 up in August 2020, and off the top we got a complex corrective structure: 3 down, 3 up, and 5 down, and that is 3, 3, 5. Remember I showed you the patterns, repeating pattern, and now you look at GDX daily chart and you see the very same pattern, 3, 3, 5, making a higher low. And look at my green target box. It is exactly where GDX found support. Tested once, 2 times, 3 times, and took off. Now when we got ABC of wave 1, we need to get ABC of wave 2 making a higher low, and that would be a beautiful 1 up, 2 down starting pattern for a new rally in wave 3. And in my opinion, the very first macro target would be around 47, 45. So essentially we would see GDX going back way up to the August 2020 top. Yeah, thank you so much guys, and again I will post a recording of that video in my YouTube channel CastAwayTrader. Thank you so much for your time.